my job really is to sort of summarize a little bit about what we've just heard and then open up to some Q&A. But the first thing I want to say, there is a glimmer of hope here this morning because I noticed that this is the OC Young Executives Group. And then I walked in and saw Mark Mullen. So I'm feeling when we listen to what's taking place, I think one of the interesting things that Jim just mentioned was to really conceptualize what's taking place with respect to the euro. Just think about your own personal situation and ask the following question. If your debt-to-income ratio is over 100%, would anybody lend you any money? Right? And that's what we're facing right now. That's very simply what's taking place right now with these issues in Europe. And if you think about it, there's only two ways to solve this problem, either decrease the debt or increase income. And the problem is that, as both of our speakers pointed out, the way the European Union is structured, countries before, throughout history, have hit these problems. I mean, this is not new. But the way that countries get out of this situation is by increasing their money supply, trying to grow out of it, or devaluing the currency. And of course, none of the countries in the European Union have those options, given that they don't have the flexibility to do either. So when you saw the slide that was shown that showed the United States debt-to-income ratio being not much better than any of these countries, well, we have a lot of flexibility that they do not have. And so the issues that were brought up here are very, very serious ones. David talked about some of the policy responses, but mostly, as he pointed out, the policy responses have been really addressed at solving liquidity issues. They have not been addressed, the underlying structural issues. Hopefully that sounds familiar to you. That's exactly what we're doing in the United States. We've got a lot of underlying structural issues in the United States, and we're not solving them either. We're just kicking the can down the road in the United States. So our problems are very deep as well. The issue in the United States, though, is that their problems are worse. So in a relative sense, we're the safe haven. Our interest rates dive down lower because their interest rates are diving up higher. And the issue for us is one which is very dramatic. With the 10-year rate dipping down to historically record lows, it's allowing our Congress not to have to make tough decisions. If you can borrow for free, why not do it? And that's why you see all of these issues. Why does the debt matter? We can just borrow for free. But you notice there's a snowball effect that David talked about that's going to hit the United States economy too. Because when interest rates rise, boy, are we going to face tough issues here. And so we're trying to here sit around and talk about Europe, but boy, we've got issues here that we've got to solve as well. But let's focus back on Europe and think about some of the solutions that we talked about. You see the different scenarios up here. And so I'm going to just sort of throw a couple of questions here at our panelists to start it off, and then hopefully you'll add to the Q&A as well. The Economist had a very interesting solution to the issues that you both have raised. It was probably about 2 weeks ago. Have any of you seen this discussion about the solution that the Economist, which has to do with, both of you mentioned, federalizing, becoming the United States of Europe. Now that's kind of conceptually very difficult because way back when, as Jim mentioned, way back when the European Union was formed, a lot of macroeconomists, including myself, analyzed the situation. We said this will never work. And the reason was that these countries are way too heterogeneous. Their cultures are way too different. Their economies are way too different. This is not going to work. And of course, as Jim pointed out, the data showed it wasn't going to work from the very beginning. So why should we be surprised about where we are today? But to make it work, it has to operate like the United States of America, the United States of Europe. If you look at the debt to GDP ratio across all of the countries, you find it's 87%. It's actually a little less than what it is in the United States. So if you could issue bonds and mutualize them across the entire European area, you would find that you could actually support those bonds with, for example, as the Economist has recommended, a VAT tax, a surcharge, an increase in the VAT tax through all these countries, and support those bonds. Issue them once for 25 years. Issue them, we need a lot of trillions of euros to do it. Issue them once for 25 years. They would be financially backed, and we could then buy enough time to grow out of this situation. So that's the Economist solution. And it's not federalizing completely because you would only require those countries that had a high debt to GDP ratio to actually do it. So countries, for example, as the Economist has recommended, with above a 60% debt to GDP ratio. So would that be a solution that you think might work? And secondly, do you think is a practical solution? Would you like to try to tackle it, Dave?
Sure. Yeah, and I think some sort of debt neutralization is definitely part of the solution. The challenge is that you've got the Germans on the one hand recognizing that debt neutralization essentially means that they're going to be footing the bill for everyone else in the Eurozone. And the basic, our view of the German position here is that the Germans are trying to force as much change upon the peripheral countries as they can before they eventually give in and allow some sort of neutralization, essentially a bailout of the periphery. The concern is that if they cave too quickly, then essentially it creates a moral hazard problem, and the countries in the periphery say, well, we don't need to reform. You actually saw this earlier in the year in Italy when Mario Monti, the technocratic prime minister, president of Italy, was trying to implement some structural reforms, for instance, trying to open up certain areas of the economy where it's a closed shop. So in other words, you have to have a license to become a notary. You have to have a license to become, to take on various professions, a pharmacist. And they limit those licenses. They close the professions, which of course isn't a great way to promote growth. So he was trying to open up professions, open up labor markets somewhat. And he was getting some progress within Parliament, but then the spreads on BTPs, on Italian government bonds, began to come down because of this ECB operation. So the yields on bonds began to fall, and the politicians in Parliament said, oh, just like the U.S. politicians, I should note, what are we worried about? Look, yields are coming down. No one's too concerned. We can borrow money. So why do we need to deal with these structural reforms? The market is not demanding it. So the Germans are essentially saying, we've got to demand it, and we've got to make the market demand it, right up until that point at which there's a point of no return. We need to push them as far as we can before we give in. So ultimately, yeah, we believe that they will give in, but the question is how long they go before they do that, and crucially whether they get too close to the edge of the cliff before pulling back, in which case their momentum can carry them over. That's the risk of dissolution.
Jim?
Yeah, I'd say if you think about what options are available, there really are four in my mind. Number one, you continue to take relief from the ECB and from the IMF, and quite frankly, that's really at the core of some of the issues around growth and austerity, so I'm not sure that that's necessarily the best answer. Number two is, they've asked for refinancing. Well, don't give us this package, let us refinance our debt. But back to your point, nobody wants to refinance the debt, and if you were to refinance it, it would probably be exorbitantly expensive for the individual countries. And number three, which I don't think is a good answer, which is, kick them out, right? So you're the problem child, and we kick you out of Greece along with the others. But for those attorneys in the room, there really is no legal provision or precedent to kick somebody out of the European Union. So you'd actually have to voluntarily leave. And I'm not convinced that Greece or other countries in that terrible situation are going to voluntarily leave. And it's like one of your parents saying, I don't want your money anymore. At 16, I'm going to move out and defend for myself. It's just not going to happen. The fourth alternative in my mind is really, it's just this concept of joint and severable bonds. And in my mind, while it's not the best answer, it's at least progress towards a fiscal union. And in my mind, this isn't as much about the economics. There's an underlying issue where this is a political problem, it's a political battle, and the countries themselves have to feel like they're joined in some fiscal manner for there to be any success. And the joint and severable bond, I think, is at least one positive step forward.
The political battle again. By the way, how many of you have kicked kids out of your house? Why don't we open up to the floor for questions from the audience? Yes, Rick?
Some of the debt figures you're showing, Germany and France maybe being major sponsors of ECB debt. When you look at debt figures, are you including their obligations at the ECB plus their own debt levels?
Generally speaking, we don't include what's essentially bank debt. So this is kind of finance ministry as opposed to central bank debt. But you could add to that very significant debt that central banks in each of the peripheral countries owes to the ECB, which is of course offset by money that the ECB owes to Germany. we'd actually argue that to some extent, that mechanism, which is, I mentioned the current account deficits need to be financed, they're not being financed privately, they're essentially being financed through the payment system, the Target 2 system within Europe, where the ECB lends money to each of those countries when they don't have enough euros to pay for the imports that they're taking in. So you've created a situation where Germany's got a big surplus with the ECB, and all these other countries have big deficits. At the end of the day, it's neutral, right? It balances out, but it's a big offset, and that actually is, in some ways, one of the ways that this debt is mutualized across Europe, because the Germans are on the hook, essentially. They're bailing out the peripheral countries because the Bundesbank is owed some 350 billion euros by the ECB, and all the peripheral countries are on the other side of that trade. But that's not in the government debt to GDP numbers now.
David?
You, in these very difficult scenarios, what do you think the impact is on the relationship between the U.S. and China?
Well, so I think the relationship between the U.S. and China in some ways is actually a lot like the relationship between the peripheral countries in Europe and Germany, right? You could argue that under the Eurozone before the crisis, there was a bit of a vendor finance scheme in Europe, because the Germans produced goods, sold them to the Greeks, and the Greeks essentially paid for them by borrowing money from the Germans, right? By selling them bonds. That's not unlike what we do with China, right? So we buy Chinese stuff, and we give them treasuries, which they hold 1.3 trillion of right now. So it's an IOU. This was used by, I don't know if you remember, Lucent Technologies, was a big IT firm. They basically went bankrupt because they had vendor finance schemes with all the CLECs, all the regional telecom companies, where they would give them routers and then take IOUs in return. So that collapsed for Lucent. So far it hasn't collapsed for us with China, because we've got now this the benefit of being the one who's borrowed $1 billion from the bank, right? You know the old story. If you borrow, $1,000 from the bank, it's your problem. But if you borrow $1 billion from the bank, it's the bank's problem. So this is China's problem now, which is, I guess, to our benefit. But they can't afford to cut us off. But ultimately, I think we do have an issue longer term with China that we think will eventually be resolved with the dollar losing at least a portion of its reserve currency status. But that's some ways off. And luckily, Europe is a distraction. As the Dean mentioned, their shirt is a lot dirtier than ours right now. So even though we have a dirty shirt, it's still the cleanest dirty shirt in the closet. So.
That's a good way to put it. So for both of you, you think about the stock market being this forward-looking mechanism that we like to focus on as a predictor. When do we know when the stock market is already devalued enough to take into account all these scenarios? Do you have a sense of when this forward-looking mechanism will hit the bottom and say, okay, we've already discounted for everything that will happen? When is it time to get back in? So that's what I want.
I don't know if hear somebody else's answer, because if I knew that, I wouldn't be sitting here. Quite honestly, no faith in the equity markets. My only concern, going back to one of the slides that I presented earlier, is there's so much correlation between our two economies. You can't help, but based on, I think, if you share our philosophies, believe that the equity market in Europe will have difficulty over the next year. So, if I'm personally investing, and this is not KPMG's view, I definitely wouldn't be very bullish.
I think we'll know when CNBC goes off the air. And fast money and all of these shows about how great the stock market is, the cheerleading shows. Then everyone's given up hope. Then that's the bottom of the stock market.
So someone else here, is Joe still here? Joe Bowles? Joe was here earlier. Yeah, Joe, remember your recommendation? What was it? The prediction of when you should get back in the market?
The day before quantitative easing.
The day before QE3, right? So Joe will let us know when that is. Yes, there's another question, yes.
I'd like to get an understanding where you think the UK will fit in this. Obviously, from my accent, you can tell I have a vested interest in the country. self-imposed kind of fiscal constraints in the UK doesn't seem to have had a great effect, and I'd like to get your opinion where you think these guys are going to end up.
Did everybody hear the question? The question is, how does the UK fit into all this?
So the UK is somewhere in between, I guess, geographically it is, of course, but from an economic perspective, it's somewhere in between Europe and the US because it suffers a lot of these debt problems. I don't know if anyone noticed on the chart, but that chart showing the growth in credit in the pre-crisis period, the top bar was actually the UK. It saw the largest increase in credit. Now, that's a problem that it shares with the U.S. It also shares with the U.S. the fact that the banking system was at the heart of the problem during the crisis. The reason it's a little bit like Europe is that even though it has its own currency and its own monetary policy, it doesn't have reserve currency, what we call the exorbitant privilege of printing the world's reserve currency, right? Everyone needs to own dollars, so they invest in the dollar. The pound used to be the world's reserve currency, but no longer is. So that meant that post-crisis, the UK actually had to address some of its issues from a fiscal perspective. I don't know if anyone heard our founder Bill Gross talk about UK government bonds about 2 years ago, but he said that they were resting on a bed of nitroglycerin. I don't know exactly what that means, but it's not a good thing. I don't think it's nitroglycerin. I think it's a risky situation. So the UK has actually addressed it, as you know, by cutting spending. They essentially cut spending across the board by 25%. In my personal opinion, it hasn't done great things for the economy. In other words, the economy is still weak. But longer term, it's put Britain's finances on a much better trajectory. We have benefited from the fact that treasury rates have been low and there's been no dollar crisis. So we've been able to, the old, Mad Magazine, what me worry. I don't know if anyone remembers Alfred E. Newman, what do we need to worry about here? But we've basically been able to say there's nothing to worry about. We don't need to cut the deficit. It's financed quite easily. We've got longer term problems I think the UK has addressed to some extent. The near term growth is going to be weak because of fiscal austerity in the UK, but I think longer term, I think the policymakers are doing the right thing to address the structural issues.
Just a couple of things to add. Just if you go back to 2008, just a couple of telling facts. The UK was actually invited to one of the key economic summits to address many of the fiscal issues related to Europe. And in 2008, the UK declined to participate. So in many respects, they said, look, this is your problem, not mine. And I think that was a telling fact. Two, I mentioned in one of my slides that last week, Spain nationalized one of its significant financial institutions. A major contributor to that nationalization was the fact that the UK deleveraged up to 30% of its stake in Spanish real estate. So again, I think it's yet another step for for the UK to walk away and say, okay, this is not our issue. And then finally, if you think about where they've sided, I think in many cases they view themselves as being with the U.S., part of the U.S. Solution to the euro rather than being part of the euro itself.
Thank you, Jim. So we've hit 9 o'clock. I'm sure our speakers will be very happy to hang around if you have any other questions. I want to thank them one more time. And we do have on that table, as you're leaving, there are antidepressants.